Kia ora Governor, kia ora to your team. Welcome and thank you for attending and for all of the work you've done to date. We've done this before. I imagine you'd like to talk to your report and answers, and then we'll have some questions.
Wonderful, wonderful. Thank you, Chair, and kia ora ana tātou katoa, tēnā koutou katoa. As always, it is a great privilege to be here in front of the committee, and it's also gives me great comfort to be here with our senior leadership team in full, not all at the front desk, but all fully armed, ready to answer questions as they come through.
Combative analogies aren't required.
So we do take this seriously. This is the review of our financial year 2019-2020. I probably want to say from the outset, it feels like a lifetime ago. And so obviously we'll put what we've been doing during that period into context. I'd have to say at the start, like all businesses globally, not just in Aotearoa, New Zealand, we had to significantly change the way we operate, the way of working. We had to refocus our priorities and take urgent actions to continue to provide cash flow and confidence into the New Zealand economy. During that period, this was largely the period dictated by the COVID-19 beginnings and arrival here in New Zealand. The economic impacts of the COVID-19 challenge really did bring forward a lot of new challenges, new priorities, new risks, and many of those risks are still with us today. While we did a lot of new activity, which I'll get on and explain in brief, I just do want to note that, thank you, that we, lay down the back line here, that we continued a lot of our strategic planned work with a very strong degree of success in terms of momentum. That includes the Reserve Bank New Zealand Bill, which is currently with the Select Committee process. A new funding agreement with the Minister of Finance, with 5-year funding agreements. This financial year we're talking, the last financial year was the last of the 5 years of our previous funding agreement. Significantly tighter working relationships with our co-regulators, both here in New Zealand and internationally, particularly coordinating a lot of the regulatory prioritisation work we had across the financial sector. Fantastic work in implementing a new payment and settlement systems process. Hats off to Mr. Bolin Savage to my far right here, we can talk about. We moved strongly in our diversity and inclusion work within the bank and also across the financial sector under the umbrella of our Te Ao Maori strategy. And we have been attacking head-on the financial risks that stem from climate change, both within the bank and across the system. So, you know, during that period, I would say we have to remember the June last year. I think we had just come into level 1. Sporting activities were just starting to be talked about again. I saw the mighty Hurricanes come a close second to some red and black machine for the first time in a long period. So it feels like a long time ago. I want to thank the board, my colleagues, our Monetary Policy Committee, and many of our support regulators for the great assistance they provided in responding to this COVID-19 challenge. So we worked very quickly, very much within our mandate of maintaining low and stable inflation, contributing to maximum sustainable employment, and making sure our financial system remained sound and efficient. To do that, we undertook a series of activities, both ourselves on our own, but also assisting broader government, in fact, the New Zealand Treasury, who were here just prior to us. They were a combination of significantly easing monetary conditions, both with the official cash rate, but also developing and deploying new monetary instruments, all aimed at lowering interest rates. And nothing else, all aimed at lowering interest rates to make sure that we maintained that employment and inflation mandate we were doing, the reprioritisation of our regulatory work, and an enormous amount of effort given our role as prudential regulator and banking the banks around helping the government roll out the mortgage payment deferrals and the business finance guarantee schemes that were implemented. All of these, as I say, were within our mandate. The shock, the COVID-19 pandemic continues to be all pervasive in the global economy. So while New Zealand is in a very fortunate position, touch wood, relative to the rest of the world, significant uncertainty remains. We will be talking more about that, how we are viewing the outlook ahead in our monetary policy statement, which is on the 24th of February. So we have to remain relatively cautious so as not to create insiders on that discussion. Just to highlight some of the big issues, the payment and settlement systems replacement was a major task. It was a multi-year task, and in February of last year, we went live with 2 new payment systems. So there was around a $29 million investment, multi-year. This is the type of system that if it's working, no one knows about it. If it's not working, everyone knows about it. We were so pleased to have it on board and to be working extremely effectively and efficiently. And it was tested within a fortnight of it being implemented, given that there was a massive increase in transactions in during the beginning of the COVID-19 pandemic. The old system probably would not have managed, just given the nature of the surge. So it's fantastic to be future-proofed on the way through. And I want to, again, congratulate our team and all the supporters they had in that implementation. We continue on our transformation as a bank. Transformation is always impermanent, otherwise you fall behind. A big part of the transformation will come from the new Reserve Bank Act. That will make us fit for purpose for many decades to come around the legislation, around the governancing structures, around the capital nature of the bank. But we also work on other parts of legislation that must be completed over coming quarters, but have significantly advanced. The Deposit Takers Act, which is about unifying banks, non-banks, all institutions who take deposits from people, the legislation there. The Insurance Act and insurance solvency is all under review at the moment. And the Financial Markets Infrastructure Bill, which is establishing a joint regulatory regime for critical financial infrastructure, joint between the Financial Markets Authority and Te Pūtea Mātua. So we will be working together on that. I mentioned the funding agreement, and I just want to note that we completed our 5-year funding agreement on target. The last year of that financial year, we were slightly over our estimated expenditure, but that was 100% explained by the rush to cash that we experienced at the beginning of the COVID-19. That's a liability to us, and the expenses involved in making sure people had access to cash tipped us over. But over the whole 5-year period, we fitted there. There's a lot of unders and overs that get you there. So, you know, there's a bit of skill and there's a bit of luck, because there was a significant amount of unanticipated expenditure. We spent a significant period of 2019 and some of 2020, if I recall right, out of our building, our number 2 terrace premises, due to asbestos remediation work that was being done. And we had a lot of new regulatory work and investment that arrived during that period. And that just shows the difficulty of forecasting 5 years ahead. But we managed to get through there in a very efficient and effective manner. I do want to just tip the hat to the strong and I would say successful work, but a long way to go. Always will be around diversity and inclusion. Our Te Ao Māori strategy is at the forefront of that. Most recently, we published Burl published through our sponsorship and support on the side, our Te Ohanga Māori Economic Review. That document is a very rich resource for all policymakers and people of New Zealand around just the important positive impact. Big parts of both the measured and unmeasured parts of New Zealand economy that come from Māori business. So that will help us a lot around the richness of financial stability, financial inclusion, and maximum sustainable employment, a very important part of our work. Internationally also, we've been at the forefront of leading conversations with our central bank colleagues from Canada, the United States and Australia on building a collective foundation of understanding Indigenous economies and their impacts, and particularly with a view around financial inclusion. So that's been very rewarding for our team. And we have a strong internal work program with success, and the team hopefully will get to talk about that here. The risks continue, of course. What we've seen has been a quality problem, a problem in itself though, around that the economy has been recovering. It sits, you know, as a strong beacon around the rest of the world, as with the health under control, and the financial stability and macro stability continuing. We've seen all the signs of economic recovery happening. A big part of that, of course, has been the housing market, which has been running incredibly hot. As of yesterday, we announced that we're putting our loan-to-value ratio restrictions back on in the housing market, and that is largely with a view to heading off growing financial stability risks that exist from excess leverage, where people are taking on very high levels of debt in a speculative fashion, particularly for investors in the housing market. That not only leaves problems within the household to those investors, but over time it grows inside of the banking institutions, and New Zealand becomes very vulnerable to the behaviour of a single asset and expected positive capital gains always and forever. So the LVR is a macro instrument. It's blunt, it's across the whole market. We try to tailor it to where the risks are most significant. So the restrictions are higher on investors in the housing market as opposed to new home owners, and because it's the investor market that is most volatile to, I would say, herd behaviour, speculative behaviour all the way through. And lastly, before I thank the team, I just want to say that this calendar year started with a thump that was called a malicious attack, cyber attack on a Reserve Bank system, a file transfer application. The bank was not the specific target of the attack. We were caught amongst a broad global attack, users around the world. I do want to state that we had no warning of the attack, which had begun in mid-December. The providers of this application failed to notify us for at least 5 days that an attack was occurring against its customers broadly, and that a patch was available that could have headed off this attack if we were made aware that any of this was happening. So, you know, that is an outcome of significant cyber forensic work on the way through. Our own analysis, of course, has identified, as always, there are lessons, there are shortcomings in our response once our own alert system said that there was someone inside our system. So the independent review that we have KPMG doing will be taking on that issue, as well as the whole lead up as to what happened, how did it happen, what could we do different, better next time. I just want to emphasise that, you know, the bank has been a victim of a crime, and yes, we will always have lessons, but you know, this is the challenging nature of cyber risks. The team have been working 7 days per week since January 6. You're looking at quite a few people who bailed on holidays and weekends, all included. And we have really got our hands now in a very good position around the nature, the scale of the breach, the documents that were downloaded, the sensitivity of those documents, the owners of those documents. And all of that is being managed through a very tightly orchestrated framework to ensure that our privacy issues are managed in accordance with the law, and that institutional risks are being managed for anyone who had a sensitive document. So I want to thank all of the institutions we've been working with for that support as we go through, and the whole of government effort has been fantastic. We'll work through this and we will learn from it, We have third-party support going there. We've engaged ID Care, for example, around making sure that all of the privacy work is managed both legally but with very high sensitivity to anyone who feels or has had their data breached. So that brings me to the end. So I'm extremely proud of the Reserve Bank, all of my colleagues and teams for the efforts they've made, and a special shout out to the Monetary Policy Committee that has external members involved as well. They only signed up a few months prior to the COVID-19. I don't think their hourly rate is really justifying the work they've had to put in through time. Thank you very much.
Thank you, Governor. Mr. Bailey.
Good, thank you, Marina, and very nice to see you this year, Governor and the team. And first of all, thank you for all the hard work. I just thought I might pick up on that last issue. I don't want to be overly negative, but the data breach was quite a significant issue, as you talked about. So as I understand it, Celeron was aware of the data breach on 17th of December and issued a patch within 72 hours to the 50 users of that system. From what I've just understood, you mustn't have heard until the 22nd of December. My first question is are they the right dates? And the patch that was available to all the 50 users, when did you install that patch?
So thank you for your observation of our hard work. On that patch, no, what you're talking about is some press release from Acellion, which I can't talk to. I can only talk to the facts that we know and the facts that are forensically understood. So you'd have to ask the providers around why they are saying that. The facts are that the 17th December date, a patch was released on the 17th of December and the 20th of December to some of their customers. We don't know who those customers are. That's their commercial sensitive behaviour. We were not one of those fortunate customers that were either notified that there was a weakness in the system and or notified that there was a patch available. We never received that notification until after we had a third-party malicious attacker inside of our system. Those are the facts. We only received outside of automated alerts, we only ever received word from Acellion January 7 around the patch being available, and we put it on immediately. So whilst what they may be saying publicly is their business, those are the facts with relating to Te Pūtea Mātua.
So just to be absolutely clear, you're saying the first notification you received was the 7th of January and you immediately put the patch on?
Yes.
And then you informed,
well, within 24 hours, you have to wait for businesses to shut, etc.
And then on the 9th...
By the way, can I just say that all of this will be revealed in the KPMG review. I do have to be careful on what I talk about because a criminal investigation is still going on, as well as a highly sensitive private personal information. But the facts are exactly what is stated as of yesterday in the press release for the Reserve Bank of New Zealand. I cannot talk to other statements made by other providers.
And in terms of the information, again, you alluded to that. My understanding is obviously as a Reserve Bank, you can request a lot of information from banks, from insurance companies, whatever. So you potentially have available a lot of personal detail, a lot of anti-money laundering information, all that type of stuff. Is that potentially what could have been released?
Again, I won't go into that because of exactly the privacy and confidentiality issues that are critical during a data breach. And I hope people understand that. The file transfer application is a very well understood application. It is something that allows, in theory, safe, secure transfer from yourself to me, for example, and it was that system that was breached. Within that, it was a very small subset of data that was downloaded. We've identified all of the data that was downloaded, and we know as a fact that unless that data was downloaded, you could not see what was in that data. So we've now been dealing with the data that has been downloaded across high, medium, low sensitivity, both for institutions and or persons, And wherever there is a higher sensitivity, we are well down the path of engagement with the institutions and the individuals on the way through. And it is a process we have to work through meticulously, because I don't want a theft to turn into operational mistakes from us as we work our way out of this.
So just on that, if my personal data was downloaded, will I be made aware that my data?
Yes.
Personally, so you're in the process not only dealing with the institution, whether it's a bank, insurance company, but also going to the corporation or the person involved.
Yes.
Have you engaged with the Privacy Commissioner?
Yes. So we've had I would say we've had the A team out. I would say the Privacy Commissioner knew immediately. To National Cyber Security, we've been operating at the ODESK working group level, watch group level, I should say. We've had the most senior experts. We've had international cyber forensic experts, both private and public, working on the whole thing. So I'm incredibly proud of how we're working our way through this. I am disappointed this has happened. Very, very
Are you aware of all the data that has been taken?
Yes.
You are. Last question. My understanding is only 50 users of the
that is incorrect.
Old system.
Incorrect.
Well, can I ask you this question? I understand the Accellion had been encouraging people to move to the Kitework system, which is a much more safer system in their view. Why was it that the Reserve Bank hadn't moved to that?
Toyota tries to upgrade you to their new vehicle at all times, but Toyota still need to keep their own vehicles well serviced. I use that analogy because it is a red herring to be thinking about, yes, there are different services provided. We were comfortable for now with the services we had. We were in the progress of transitioning, upgrading to different services. It sits in a pipeline of a significant multi-year investment. This breach could have been avoided if we had been made aware that it had been breached and that there was a patch. We were not made aware.
Michael, last.
Well, that's an extraordinary comment about a 20-year-old software system. I mean, I'm well aware that providers...
the banks had it for around 7 years, and the service level agreements and provisions are exactly that. It is still seen and used.
Well, I'm reading from the Excellion press release. So
that's good.
Clearly there is a major difference between your version of what occurred. Sorry, that's an unfortunate term. What you have just told us and what Excellion released in their press release on January the 12th.
Yeah, and again, I can't talk to Excellion. You'll have to talk to them. I can talk to the facts of the Reserve Bank, and I've stated the facts. Okay. I wouldn't be doing this lightly.
So my question is this: is there an IT? Is your director of IT here?
Yes.
May I ask that person how often, in a business as usual sense, Excellion would be sending software upgrades and or automated alerts, notifications, communications between a major software system and one of its clients? What's the business as usual communication? Because so I find it, no, please answer the question.
Yeah.
Sorry, this is Patrick.
Do pull up a chair if you need to, because we need you in the mic for transcribing.
Good morning. My name is Patrick Holler. I look after business operations at the Reserve Bank. In response to your questions, we receive updates regularly. There is no particular schedule for that particular system, Excellion FTA, but whenever there are upgrades available, we are usually informed by Excellion there is an upgrade available or there's a patch available, and then we apply them.
So I'm really pretty ignorant of this, but you know, I mean, we get upgrades on software all the time that are basically pushed through. It's more technically difficult, obviously, with a big system like this. But what I've just heard you say is they're pretty regular. There's not an official schedule. Could you define pretty regular? Monthly, 2 monthly, 3 monthly?
It could be every couple of months. It really depends on what the owner of that system, Excellion, finds and what they want to upgrade. That's not driven by us. That's driven by the owner of that system. So
I just want to make it really clear. What you've told the committee is that a company that has a practice of pushing notifications through and software upgrades knew in mid-December that it had a cyber risk, developed a patch within 72 hours and did not send it to you until 17 or 18 days later. Correct?
That is correct.
All right, I think we'll leave it there.
Thank you.
You can retire.
For now.
Just for now. Chloe.
Morena. Under the Official Information Act, we have your advice issued in tandem with Treasury from the 29th of January, where you speak to the use of unconventional monetary policy as something that you do not think needs to be used at that point in time and don't see being used in the immediate future. What changed between then and March?
The significant economic impacts of COVID-19. The reason that we provided that January 29, we're talking last year, advice was because we're already observing internationally people hitting a lower effective bound on the interest rates. They were negative in some countries, but starting to get towards the end. And we were saying, the Reserve Bank need to be thinking about additional monetary policy tools if we ever got to that situation. Given that we were quite close, at that stage, I think the nominal interest rate was 1.75. 1.0%. So that was, within a whisker of zero anyway. So it was about being prepared. And then we had, of course, the economic shock, the COVID outcome, which showed a massive, what was it? I think it was a 14% slump in one quarter's GDP, where rather than immediately take the official, we needed to loosen monetary policy, and we saw it as more effective, more efficient to be doing it with these additional tools.
And obviously with an awareness that this would lower interest rates, and in turn your own advice reflecting that this could in turn have flow-on effects with regard to wealth inequality, but we'll get to that later. So would you say that you've achieved your kind of key performance indicators as the Reserve Bank with regard to, in particular, price stability and maximum sustainable employment therein, with this response in mind?
It's always too early to tell, and it's always an ongoing game, but at the moment inflation remains around 1.5% and 1.4%, and unemployment at 4.9%. They are well in excess of the alternative if we had not taken those significant monetary policy actions.
Of course, there are, however, externalities to those goals, one of which is identified and alluded to earlier with regard to the growing wealth inequality, and particularly asset prices, particularly in this country, as we've had you in front of this committee before, 2/3 of wealth in this country in housing. Do you think that we have seen that realised, that growing wealth inequality that you forewarned in March?
Yes, I mean, the asset prices have moved. I wouldn't say, we don't forecast where they think they'll move. We give a general direction that what we're asking people when we lower interest rates is we're making spending and or investment more enticing now rather than in the future. So you will see an increase in spending, an increase in investment. On the investment side, it then comes down to a choice of what investment. Is it in your own business? Is it in listed equities? Is it in the house? But
surely housing, and you recognise this, is a far more attractive investment. Given policy settings.
Well, I can't provide investment advice, but the vast bulk of New Zealanders, and you've seen a significant part of the desire to invest to go up the risk curve going into housing.
You've indicated in the past, and it's actually alluded to in this advice, that those distributional impacts have to be actually addressed by fiscal policy in particular. Do you stand by that?
Yes, yes, and I say I halted there a little bit. I'd say that monetary policy is incredibly limited in the longer term structural type issues you're talking about, which is what we were alluding to the Minister, and that where it comes down to the broader fiscal regulatory type work around.
Can I sup on that? Because obviously we in this committee read your forecasts, which were thankfully not on the money, so to speak. In terms of the program monetary policies you have been applying, had you taken a different approach, what would have been, can you just talk us through what might have been the likely effects on inflation and how that would have unfolded in the wider economy?
Yeah, so very, very briefly, a different approach I'll say is that we didn't ease. So it would make almost no difference whether we ease via an OCR, an LSAP, a funding for lending. That's all exciting news, but that's just in the background. It was around by not lowering interest rates, irrelevant of which vehicle we used, you would have higher than otherwise unemployment, you would have higher than otherwise interest rates, and a significantly higher than otherwise exchange rate. The types of estimates, Christian, you did some background, kind of the exchange rate would be
5 to 10% higher than what it is now.
Right.
And of course, you've achieved those KPIs. Like, I'm not disputing that at all. What I'm speaking to is the externalities, particularly growing wealth inequality, particularly in the sense of housing in this country. You spoke to that in your opening remarks. So you acknowledge that that's happening. You've also responded with regards to changes to LVRs. So with all of that in mind now, noting that the RBNZ itself has identified that wealth inequality, particularly in the form of housing, is a big problem in this country, and you're responding with the monetary policy tools that you have at your disposal, whose responsibility is it to respond to the housing crisis, given that you're doing everything that you are?
I would say for economic policy, it is always, you know, the overarching policy of the government of the day. So
you think you're doing everything that you can? Fiscal policy.
Nicola, you hit us up on this, was it?
Yeah. So on the loan to value ratios, acknowledging there's been a series of extraordinary events, but we can always learn from them. In retrospect, did you move too soon and go too hard in removing the LVR restrictions in April?
I think it's kind of a hypothetical question, really. So,
I stand by the decision we took at that time, which was, as the Governor has said, was a pretty dark and very, very uncertain and problematic outlook at that time, and we wanted to get out of the way of hindering it and doing the best we possibly could to sustain the economic recovery. So these are sort of cyclical tools. You tighten them when things are going too fast and you need to lean against excessive credit growth and risks building, and you remove them when there is a little credit growth, when they're not really, binding, but they could have side effects that are nasty. And we were worried about some of those side effects, mortgage deferrals and various other things. So look, that, the world of April, May last year was a very, very dire picture. What we've done is recognise the risks, and we've brought them back. And we recognised that. We said that in November we were going to bring them back. We started consulting, and we've brought them back and tightened them significantly. So risks haven't crystallised to a huge extent so far. What we're doing is leaning against risks that are coming. So, there's more high risk lending, but, obviously it takes a while for that to build up big risks in the system. We're leaning against that, so they won't be there in the future. So no, I don't think the timing is problematic.
Just to clarify.
Yes, Governor, I see your vision is to be the best central bank, which assumes you're...
It's in the world, not New Zealand.
Well, around the world. I assume it's around the world. Otherwise, you're setting your target very low. Which assumes, you're obviously keeping a pretty close eye on what's happening around the world. Is there any economy that you're aware of that lowered interest rates where the housing market didn't take off?
I would be struggling to point to a country where that is the case, where interest rates were lower without an increase in asset prices first and foremost, because that is a key part of it, and to the extent that housing was preferred housing as well. Different timings, giving starting points, different levels and variations, but the same story. Lower interest rates tend to mean higher asset prices, in almost a mechanical sense.
Right. So in all, in all your case study, then if you raise interest rates now, you can assume there'll be a corresponding drop in house prices.
Yes.
And scenario, a slowing in growth at least.
Yeah, slowing economic growth, and that in part may feed through into both manifested by less investment in some activities, including housing, and or less employment, and hence less ability to afford a mortgage, and higher interest rates mean mortgage servicing would also be higher. So, there's some very clear mechanical behaviours going on, and it is a global phenomenon.
Right. I'm aware that there's a lot more that's going on in the Reserve Bank. So, Nicola, a new line of question.
Given your warning around financial stability risks, I'm interested in your engagement with the Minister of Finance on this, and in particular, do you think it's time that he refreshed the 2013 Memorandum of Understanding on macroprudential tools? And were an update to occur, do you think it is worth consideration carving out different LVR requirements for first home buyers into the future than there are for other types of investment? Is that something you're actively considering, and what are the implications for financial stability?
Well, we think we need the flexibility to be able to apply the tools that could lean against the risks in different ways that they occur. So we have, as recently as a letter back to the Minister, indicated we'd like to consider having debt to income or debt servicing ratio tool. You know, every tool you have has some side effects, some positive benefits, but potentially some side effects. So you have to evaluate that and put those into a regulatory impact statement and consider those things. But having a range of tools that we could lean against the way that risks play out would be preferable. So yes, that short answer is we'd support revisiting that MOU. You know, we continue to be in discussions with the government about their broader housing policies. There are a lot of things that the government can consider in a broader sense and should consider in a broader sense to support a housing market that's got supply and demand dimensions to it.
Would you have expected that Memorandum of Understanding would have been updated given the urgency of these issues?
I think, you know, no, I mean, I just, I'll come back to a couple of bits first. The Reserve Bank many years back, and I'll speak, I mean, Jeff was there for a large part of it, suggested these tools anyway, and they have been not accepted by a series of governments because of the difficulties. There is no silver bullet. For example, debt to income ratios can mean it's much harder for first home buyers. And so if your policy is to have more first home buyers, well then are you working right, you know, so they have been on those balances of risks. The political economy decisions have been some but not other tools, and that hasn't particularly changed. You know, the tools remain what they are. They haven't evolved.
Right, Ingrid?
You mentioned with some pride your diversity work. Apart from that being a good in itself, can you please explain what impact and expected impacts that will have on both the way you do business, but also the marginalised communities that will be represented through that work?
Yeah, so I just wanted to do, chat around some of the core work.
Yeah, sure. So, I mean, certainly on our Te Ao Māori strategy, we're seeing the impacts across our core remit. So, you know, we're looking through a Te Ao Māori lens across our financial stability work, through our monetary policy work. We're broadening our stakeholder base, you know, the people we consult with as we are forming and thinking about our policies, but certainly also within our own workforce. So we're bringing in a more diverse workforce, and obviously that will take some time, but we are building our range of perspectives, if you like, and hopefully Te Pūtea Mātua will be more reflective of the society in the New Zealand that we seek to serve.
The really core parts, and I want just to chat to the broader diversity, to say there's core parts of lessons. When we got our employment mandate, the significant burden of unemployment fell on Maori and Pacific Islanders. So for us to be able to know if we are maximising our contribution, then we need to really understand what is going on, not just in some formal but informal sectors and the whole work. So it's been fantastic, and also financial stability. Significant investment now is held within Māori trusts and Māori organisations, and as the Te Ohanga report shows, Māori employment and entrepreneurship is a key driver of economic activity in New Zealand, and financial inclusion remains a key challenge. So we are making sure we are not in the way, but also what can we do to improve access to capital on the way through.
Do you analyse risk? Sorry, if I can. Do you analyse risk for Māori business and entities separately in terms of the fact that their asset base is often distinctive?
We have had a lot of work and thinking about it. I put a speech on record to, in fact, it was the Federation of Māori Authorities late 2019, and it really highlighted the fact that the lower leverage ratios, the longer term investment strategies, the nature of the assets often means they are lower risk businesses, which in a lot of sense from a central bank view is good. You know, in that reinvestment space, that's not all business.
So I suppose the other thing to note is we have a cross-bank working group looking at how we can, I suppose, improve our diversity and inclusion ourselves. So I think the work we do, we obviously need to have those wider views reflected in our own workforce and our own approach. So we have a couple of things we're looking at, improving, I suppose, the percentage of women and women in leadership roles within the bank. So we have set a target for 40% female, 40% male, and 20% swing either way. We're doing pretty well on that. We've got now 42% women in the bank, 39% of our people leaders are women. There's some work to do on the wider diversity metrics too. So we'll be looking at a more data-driven approach and setting some targets around that too.
Just to sup on that, you'll be aware that many of our Muslim communities can't access housing through our systems not meeting their religious requirements. What work has been going on to help overcome that in accessibility?
It's really interesting you bring that up, because that conversation came up finally, I should say, and we'll be tabling that at the Council of Financial Regulators. A lot of the issues don't sit directly with us, but that's not us hiding from it. We need to be thinking around what role can we take in being innovative in the Sharia type lending activity.
Yeah, just a really short sup on that.
Can I just have you, I'm aware of time, and there's a wee list, so if we can keep those questions short, we'll try and get through everyone. Particularly for first-time buyers, one of the major opportunities presented to get into the market is apartments, but a number of banks refuse to lend when it comes to apartments smaller than 50 square metres. Is there any work being undertaken on that or changes to it?
Not aware of specifically.
No. Okay.
Perhaps there could be.
Damien.
Yeah. Nothing. Governor and team, Damien Smith from the Ag Party. Just to be clear, with the economy recovering, although not at full capacity yet, unemployment improving, what is the strategy to stop asset price inflation? Because surely it is becoming unsustainable, both at a retail banking level, to land this gently. So I just wanted to have a summary.
Yes, so I think the easiest way to respond to that is really in our response to when we exchanged letters with the Minister of Finance late last year, and we outlined the role that we could play, the Reserve Bank of New Zealand, and also the cast of many, because it's both a supply and demand issue. For the bank, we are mostly influential, and even then only at the margin, on the demand activity. And we've talked about the loan to value ratios and leaning more on investors, given that they are more the, I suppose, the hot money that drives the speculative behaviour. You know, that's where we go, but then there's a huge other area around all of the access to land, supply of buildings, etc., that are across. I think we counted up 17. We were told that we missed quite a few and that we undersold and oversold others, but you get the idea that there is a significant cast involved right through the value chain of delivering houses and the demand behaviours around housing.
Is there a strategy to
for the Reserve Bank, we remain committed to our mandate. Within part of our mandate, we try to head off excesses in leverage because of the risks that involve, and that's what we're doing with our LVRs at the moment.
And just one last question. In terms of the spectre of interest rates being low and inflation increasing over the next, not just this government cycle, but the next government cycle potentially, is there any thinking behind that in terms of any concerns?
About interest rates being what? Sorry, low?
Well, if interest rate strategy is to be kept low, then obviously we have an inflationary aspect that could be coming.
The only reason interest rates would be kept low is if inflation remained low. So, you know, we remain first and foremost aiming to keep consumer price inflation between 1% and 3%. and that will be the determinant of any future interest rate path for this country. We are operating at low nominal interest rates globally because of low inflation globally and some recessions internationally. And with low nominal interest rates, particularly for the first time in many people's working life, that is leading to some of these, asset price stretches that you're seeing internationally. So,
Right, thank you. Anna?
Well, I just wanted to ask around the business guarantee loan scheme uptake and sort of how is that sort of reflecting a better attitude from banking confidence in business, and how's that sort of feeding through to sort of growing business growth and that?
Yeah, thank you. It's an interesting question because the scheme obviously was one of those ones was designed again right at the peak of trough of the pandemic, and it had very low take up for quite a period of time. But more recently, December, I think over $500 million went out through the scheme. So you're seeing a much more of a flow of funds when they're sort of in a more of a recovery phase. It really, probably didn't quite work in the immediate response phase. Businesses were just very uncertain, clamping back. They had protecting cash flow in other ways and so forth. So they didn't borrow from that at that point. Banks probably also very cautious as well, then, to be fair. So it's a combination of those things. So you're seeing now much more use of it. It's contributing, I think, to you're seeing some refinancing at lower rates through the scheme, and hopefully it's going to support this recovery phase and the investment that the government was talking about that we need to see start to come. So yeah, I think there'll be some learnings that we'll look at this and evaluate these schemes over time, but it does appear to be starting to play a more important part in supporting the business recovery phase.
Yeah, the sun's out, the umbrella's coming out.
Well, it's some of that, and that's always a difficulty of how do you can push on a string and people don't borrow. Banks, everybody was cautious about how long this might play out, and you just protect yourself. And we obviously were encouraging the banks to be open for business and to try and do that through that period. But to be fair, everybody was.
I was thinking, just like took a sip of water. I mean, all we could make sure was the water was available. We couldn't make the horse drink. And
the horse wasn't drinking, was it?
It wasn't. No. So,
all right, Andrew.
Thank you. You mentioned your letter before, Governor, on 9th of December, and I must admit I thought it was a very good response to the government. You're probably aware, yesterday I was asking the Minister why he was so tardy in responding to you. Were you expecting, or are you expecting, a formal response from the Minister of Finance?
Yes. So we've been in dialogue, and the government, to my understanding, is formulating a formal response. We haven't received that yet, but it's around both us and going off public comments as recent as yesterday. It sounds like that response will be across a broad range of activities. We're not inside to that, but we are anticipating a formal response.
So you asked two specific issues in that letter. One was around DTIs, debt to income. Have you had a response on those yet? And you just mentioned before you thought they were disadvantageous.
No, we haven't. So I assume that will be part of the formal response as to whether it's a yes or no, or whether there's more work to be done or something like that.
Have you been doing more work around capital adequacy ratios for banks and prudential controls around that? Is that an area that you've been focusing on?
That's an area of permanent focus, and that was the grand topic of a lifetime ago, I think 2018, 2019, wasn't it? Where we had completely refreshed from ground up around what we thought was appropriate capital ratios, adequacy, liquidity for deposit takers here in Aotearoa, New Zealand, and we made our decisions. We're now in a process of saying migrating to those new capital levels. We put that migration on hold during the COVID period, and we said in 2022 we'll be back.
But if you, and I understand that one, but the issue around, and it's been raised before, around housing, we've got a lot of investment going into housing. Have you been looking at using that tool to make sure that lending doesn't end up in housing, which is obviously the easiest leverage for banks? have you been looking at that type of?
We haven't had a specific work program on that at the moment, but that is always sitting there in our thinking.
Yeah, we have reviewed our settings as to, how they accord with international standards and satisfied ourselves that actually we're conservative as it is on the housing risk weights, which is what you're referring to. So
asking for a lot more capital than many other countries.
Yeah, we do.
So Greg's got a supplementary.
Yeah, just to start, I somewhat facetiously mentioned the umbrellas coming out now when the sun comes out with the banks, but isn't it what we've learned is that really when we need liquidity in the system, you can't rely on the banks. Isn't that the lesson we've learned in the last months? Certainly with people I was dealing with who couldn't get finance.
There's a combination of two things, and I'd say more incentive structures. I'd say the number one challenge that was out there was not banks, but individuals, business owners who were saying, is this really the time in such a world of extreme uncertainty to be increasing my debt or using up my facilities? And that was the number one challenge. Without doubt, within the financial sector itself, you're asking them to open up brand new ideas, and you're asking them also to be thinking about things that might not be in the immediate short-term best interest of their shareholders, will be in the long-term best interest. So I would put the biggest challenge was business itself being incredibly uncertain and unwilling to increase leverage. Yes, there were also a lot of anecdotal evidence around people really challenged to actually access what was available.
Supplement to that, but are you saying now that we're seeing a really, business confidence and backed with the banks as well? We're starting to see a real drive in the investment area. So that's a deal of confidence.
It is absolutely. I mean, this is what monetary policy largely does as well. It's about influencing confidence now versus the future and so on. Low inflation, that's what we're seeing, an improvement in confidence from a very, very dark place to a somewhat lighter place.
All right. Well, we've got, I think, the final line of questioning, but you're going to have to choose between the two of you.
Thanks. I pull rank. Governor, you talked about the 5-year funding agreement in your introduction, and I just want to test a few things here. But you guys must think you've hit the jackpot. I have never seen an organisation have approved an increase in its net expenses by over 110% in 12 months. Now, so I dive into the proposal dated August 2020, and in its introduction, you say, well, we've got this COVID thing, but this proposal doesn't really take into account all of the COVID impacts. So what is driving this extraordinary increase in the Reserve Bank's resources? Because your three, digital services, supervision of building premises doesn't really.
Well, they are the three major drivers. So that's the case. I think it's important to think about a couple of things. One is that this is a 5-year funding agreement, hence it hasn't been changed for 5 years prior. Significant changes have happened during that 5-year period. And then also over the previous 5-year periods, we were getting something close to a zero change, which has led to significant underinvestment in our building, our capability, our capacity.
Well,
and to be able to sit here and explain in our funding agreement, in our document, we explained exactly the level of risks we were facing, and we challenged the minister to say, are they appropriate, or do we need to invest to reduce those risks to where they are appropriate?
It might need to be in another document. I've got an 8-page document that does anything but that. And as to your point about the previous 5 years, it was very satisfactorily ticking along with relative. I'll rephrase that. Your staff has been stable for a long time.
Our staff got up to around a 20% turnover, which when I arrived, I was told was bordering on something of a high risk status. So,
well, I've got your turnover here, and it did tick up in 2018, I think. for 2019, but again, relatively stable. My question is this.
Put the question, we're almost out of time.
So you've had a 48% increase in personnel costs since this government came into office. You've had a 39% increase in staff, a 36% increase in the number of staff earning 100,000. That's to date. And next year, you're going to an increase of staff by about a third and double the net expenditures. Don't the public kind of need a better story? Because, you know... So,
look, Governor, you see the question. It's an invitation to explain the budget increases. And perhaps if you'd respond to that, and I think...
yes, I can. The document, I'm not sure what Mr. Woodhouse is the document referring to, but I can furnish a significant document which was put together as our funding agreement document, which outlines, in fact, our Chief Financial Officer is, you want to waive that as on the record evidence. It explains detail by detail by detail the risks that we were holding and the risks we needed to close. And they came down to a large part around the capital investment. You had just finished questioning us around whether our 20-year-old FTA system was up to date or not. You can't have your cake and eat it too. We need to be investing these activities.
Okay, Chloe, last very short.
Can just be yes or no. Does the bank forecast that the $100 billion limit for the LSAT program that we've discussed at length today is going to be reached?
It's a, I don't know if I can answer it, a yes or no.
It's a question for the NBC.
You're a financial advice committee, so no, I can't.
All right,
we'll
an excellent note on which to end. Thank you. Look, thank you very much for attending. Always
thank you.
Thank you.
Wonderful.
Thank you very much. Thank you very much. Thank you.